Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. With the cash trade just less than an hour away, here's what you need to know. Fed fear factor. Stocks pressured after a sharp sell-off on Wall Street as markets brace for a hawkish pivot from Powell. Most European markets are shut for May 1st Labor Day holidays. Amazon's AI boost. Shares in the e-commerce giant jump after reporting strong cloud unit sales on rising AI demand. We will bring you earnings from UK corporates, including GSK and Next. Plus, BBVA tells Sabadell it's interested in exploring an acquisition in what could be one of the largest European banking deals in years.
In the meantime, quick check on these markets here. As you look at the futures picture, you are seeing FTSE 100 futures unchanged at the moment. We also mentioned that Euro Stoxx 50 futures are trading. The futures contracts are trading, even though the rest of the markets are indeed closed. It looks like we are seeing yesterday's pricing on that, though. So keep watching. We will bring you the updated pricing there. Two-year yield sustainably above 5%, 5.03. We're going to dive into some of the mechanics there. And cable weaker this morning as well, 124.74. Markets today starts right now.
Wednesday, the 1st of May, awful April is finally over. Stock markets didn't enjoy April. Will they enjoy May? It's May the 1st. For most of Europe, that means Labor Day. That means that most European markets are today closed. The UK is open. I think Denmark is open as well. We'll look forward to those markets opening a little bit later on. But it is a day, of course, that is going to be dominated by the Federal Reserve. That meeting comes up a little bit later on, or the result from that meeting comes up a little bit later on, with markets very much on tenterhooks to hear exactly what Jay Powell has to say. In the meantime, though, we have lots to deal with. We've got JOLTS data coming out a little bit later on, ISM manufacturing. But before we get all that, we need to digest the earnings, which start here in Europe this morning with GSK.
Yeah, absolutely. Some better news out of GSK, it seems. An upgrade to guidance coming through this morning from the pharma giant. They see full-year adjusted operating profit 9 to 11% higher. That's the guidance now. They had seen the range of 7 to 10. And on adjusted EPS, they're also guiding a little higher this morning. And this matters because there had not been an expectation that we'd get a guidance upgrade. I guess that's a sort of weird thing to expect anyway, because if you were expecting it, maybe you would have priced it in already. But anyway, we had heard from analysts that it's too early in the year to upgrade guidance. And we'd also heard from analysts that this is a business that trades at a discount to other EU large-cap pharma. So when you see that kind of business with that kind of pricing upgrading its guidance, you wonder where the stock goes.
Yeah, we should mention that Haleon actually also, which I believe is their consumer spin-out of GSK as well, coming out with their numbers in tandem as well. Their adjusted operating margin, though, coming in quite hot as well, 24.2% there. The estimate was about 22.9%, but their revenue is actually coming bang in line with estimates. So the operating margin seeing a little bit of a boost this morning.
Yeah, there's some interest in what they say about their China business at Haleon, because there's going to be a renegotiation this year of their deals, of their terms of trade, if you like, in China. And so there have been concern from some analysts that that could be an area to watch. We're also watching Next, but maybe all the good news is in the price around Next. We'll see. But guidance for the full year remaining unchanged. But this is after a recent, very positive statement coming through from the retailer, talking about real wages on the rise in the UK. That said, that's the positive story, and the management's made quite a lot of that. That said, just yesterday we had that deflation story in the UK, at least in the non-food side of things. We're seeing deflation, not disinflation, but actual deflation for the first time in more than 2.5 years. So that's certainly something, a dynamic to watch when you're dealing with a business like this.
I love this headline. Q1 retail sales plus 0%. Is it plus? Is that plus?
Is there a rounding? There's some rounding there.
Maybe. Trading at full prices plus 5.7, which does imply some discounting. And the EPS, the full-year EPS still kind of 606, estimate 614 there. So maybe some disappointment, I suspect, maybe in the next numbers a little bit here.
Well, speaking of disappointment, look at these Aston Martin numbers as well. A pretty big miss on their revenue numbers, 267 million. The estimate there was 290 million as well. Their wholesale volume units, 945. The estimate was just about 1,200. So a pretty big miss for Aston Martin as well this morning.
Upper-end cars are beginning to struggle a little bit, which I think is interesting.
We saw that in Mercedes, didn't we?
Saw it in Porsche as well. So Friday we saw Porsche, Monday we get Mercedes, Monday, Tuesday we get Mercedes, and now Aston Martin may be confirming that trend as well. So that upper end of the market, which everybody thought was very secure, may be feeling a little less secure, which kind of fits with the broader narrative of what's happening in the luxury space. Always nice to show some nice Aston Martin.
Any excuse to show the fast cars. Talking of cars, maybe that takes us nicely on to what we heard from US corporates overnight. We've got some earnings stories. We'll get to those. But we also heard some news from Tesla, and I think this is interesting, given the number of times we certainly talked in years past on this channel about the lack of charging infrastructure in various places.
Yep.
Well, this is the US story predominantly, but the superchargers that Tesla has been putting in place, that a lot of other automakers have been tapping into, they then announced, it seems quite out of the blue, perhaps, that all of the staff from their supercharger unit are going. That is in addition to the 10% of staff that they announced were already going from Tesla. So this is a business taking cost-cutting very seriously, of course. But they are still talking about increasing that supercharger business, just not quite as quickly.
Well, the EV space in the United States is really interesting because in some ways they're obviously competing with each other, but they're also partnering, to your point on this infrastructure story, at a time because Tesla actually has, or did have, I should say, past tense, the money to actually put forward towards that infrastructure. They were getting a lot of government subsidies to expand that charging infrastructure. Largely in California, for example, that was kind of their big hub to actually be able to do that, as opposed to the rest of the United States. And it was still very much experimental because, again, it was driven so largely by, of course, Tesla's personal funding, but also that government subsidy story. What does this then do to Biden's kind of political agenda as well in terms of that EV transition?
They've established a standard over there as well, which is interesting. So others are now going with their standard, the North American standard or the American standard. I can't remember exactly what they call it. But others like GM have been using that. So this is a blow to them. It's a blow to Rivian. I have to say, the first thing, when I saw this headline first thing this morning, and this tells you how old I am, I looked at it, why does a Tesla need a supercharger?
Oh.
And then I worked out, obviously, that's to do with electrics, not air. Anyway. We'll see how that one plays out, but I think it's bad news for the rest of the sector. But I think it speaks to the stress that Tesla is under at the moment. In order to need to cut costs, this is where it's cutting costs, despite the fact that this is where its audience, in so many ways, wants the improvement. Range anxiety still exists, and it really exists in the United States. Like, it exists here, but it's a massive problem in the US.
Yeah, talking about these standards, charging standards, North American standards and the others, it takes you back to all kinds of other iterations of that drama through technology history.
You're going to bring up the Betamax now, aren't you?
I was not going to go there. I was not going to go there. I was not going to age myself so much, Guy, but yes, we can do that together. Amazon, also in focus, very different story. The stock up more than 6% after hours, really accelerating sales growth, AI contributing significantly to that accelerating cloud sales growth. So a positive story coming out of Andy Jassy.
But less on the retail story. So it was interesting. The stock initially climbed quite strongly and then fell. And I think it's going to open a little, versus the close of 175 yesterday, it looks like it's going to open positive. But the market went on a real roller coaster ride with this stock as it tried to kind of factor in all the various elements. Yes, the AI story is strong. Spending is going to have to be quite aggressive in that space. But the consumer actually looks relatively weak, judging by this data, and that fits with the Starbucks story too.
It does. Two thoughts. The first is on Amazon. Amazon Web Services only makes like a third of their revenue. They are still largely e-commerce business.
Yeah.
Exactly. A lot of profit. We know that Andy Jassy was formerly the head of AWS before he took the helm as CEO as well. So it's very clear that investors are viewing this company as a tech trade, as an AI trade, more than a consumer trade, even though they do have a larger consumer business and a logistics business, by the way.
And an advertising business.
And an advertising business. They do a lot of different things, and yet it's still that cloud AI story that investors are kind of harping on to. The Starbucks story I thought was really interesting for a variety of reasons because they... Go ahead.
No, I have two words to say on Starbucks, but you go first.
Caramel latte are the two words that come to my mind. But I think what's important about Starbucks as well is that they actively talked about the losing kind of China piece of the equation. Luckin Coffee, for example, talked about competition hurting their business, which seems normal, but isn't this something we're hearing from CEOs a lot? Ericsson, for example, saying that the idea of protecting competition in various markets is actually hurting them.
Yeah, more. I mean, is it hurting their pricing? You talk about $6 lattes, then maybe it's hurting the pricing is what's happening here. So you went with caramel latte.
What's yours?
Lavender latte?
So I thought of that this morning. Oh, my Lord. In a gin and tonic,
I had quite a physical reaction to reading those words.
I was like, why would you put lavender into a coffee?
I don't know. There's something I don't understand
little kind of sprigs in a gin and tonic, maybe.
Something else is happening.
But anyway, caramel I have issues with as well. Coffee should be smaller, not larger. Smaller, better. Larger, worse.
Well, we'll see if the Fed has been drinking any lavender lattes a little bit later. We'll see how that's influenced their thinking. We get, of course, the Fed decision later on today. That's going to dominate things. And in a day when a lot of European markets are closed, as we've already discussed, and a lot of Asian markets are closed, it's even more going to be about the Fed, as if that was even worth saying. But this in the wake of what we saw yesterday on the employment cost index, wages hotter than expected in the US.
Which is surprising, right? Because we'd expected that number to come in hot anyway. There are a lot of minimum wage increases. I think around 25 states out of the entire 50 had this. So there was an expectation it would come in a bit hotter anyway, just as kind of a first quarter seasonality thing. It came in even hotter than that, which is suddenly a problem. When we're talking about inflation and kind of tackling inflation, a big piece of that concern is affordability and whether wages can keep up. Not only are wages keeping up, they're actually kind of almost outpacing inflation itself and therefore driving it.
Get jolts today. 10 a.m. Eastern. You get ISM manufacturing at 10 a.m. Eastern as well. So I think those are two really important pieces of data. I'm actually interested to see whether the manufacturing story is continuing its rebound off the trough, out of the trough that it's been in. That'll be, I think, interesting. But certainly the ECI would appear to have given the Fed reason to harden its language when Powell speaks a little bit later on. But the market feels like it's very positioned for a hawkish sort of statement coming out of Powell. And I do wonder how can he match the hawkish expectations? We have reversed an awfully long way very quickly.
Yes, I mean, the market is now expecting something that, December is a long time ago. So the market expects that the messaging is different. But is it going to be materially different to the last couple of weeks from Powell? I suppose that's the question. We've got a number of guests coming up on the programme this morning who can give us their thoughts on whether we need to see any change in direction from Powell. Or has he already done justice to the, yes, we didn't get any comfort from the inflation prints in January, February and March either, which is what we've heard already.
Well, it's kind of, they've almost backed themselves into a corner, right? What they can't claim it's a one-off anymore. You've had 3 different data prints with 3 significant months of beats in the CPI, the PPI, the PCE deflator, and now the employment cost index, among other as well. You have a 2-year yield that is still sticking above 5% and still climbing, by the way. So the question is then, could you even consider higher long-term yields that cross 5% and stay above 5% for longer term? What are the ripple effects across that around the world? The other piece of the equation as well is what the Treasury does, because we have that refunding announcement 30 minutes before the FOMC decision. What is the bond market more reactive to?
Well, there's an interesting kind of pair there, isn't there? Because you've got that funding announcement, but you've also got the potential for QT to be dialed back so that Powell basically signals we're going to continue to do QT, but at a lower level for longer, so we don't upset the overnight lending market and cause all kinds of problems. But I think it's going to be, I think, does he keep the language in there? Is the statement keep the language in there that says we still see the next move as a cut? If that disappears, I think that would be a hawkish surprise, maybe.
And we get no dots today, do we?
Nope.
Is that right?
No dots.
We get no dots.
No SEP.
So he could still be asked, where do you think members of the FOMC would put their dots? Or words around that kind of question. Or
are the dots out of date?
Yes,
I think probably
maybe it's
would be the
worded
question.
that way. So then, and how will he respond to that? That's going to be crucial.
Yeah, and I'm going to bring it right back to the bond market question as well, because we had a guest on yesterday visiting from Athens, actually, who was talking about this, that perhaps when it comes to whose responsibility it is to make sure that the bond market actually functions normally, it's not the Federal Reserve's responsibility anymore. And it felt like it was, say, third quarter 2023, a lot of that focus was on making sure financial markets are smooth and easy. And now that kind of onus, that responsibility has put on the Treasury. And I'm curious if Jay Powell is asked about that and what he says in terms of coordinating with the fiscal response at a time when they're trying to be separate from the fiscal story. Of course, all of that in our special coverage of the Fed decision at about 6:30 p.m. London time, 1:30 p.m. if you are in New York, and of course, if you are in Asia as well. That's 1:30 a.m. for you. I'm sure you're going to be staying awake for this one. In addition to the Fed decision, there's a couple other things to watch out as well. We mentioned that U.S. Treasury quarterly refunding. That's coming 30 minutes ahead of that Treasury decision, 1:30 p.m. London time as well. Excuse me, that's wrong. 1:30 p.m. Eastern time. That's important to keep in mind. 30 minutes before the FOMC decision as well. 3 p.m. UK time, though, you get the U.S. JOLTS data and the ISM manufacturing report as well. So, again, more data points. Do they all suggest the same trend? And, of course, it is Labor Day. We've also mentioned that many markets are indeed closed. Does that create a light liquidity story, especially when it comes to those bond markets? We're going to keep you posted right here on BTV. And then, of course, it really is coming down to the Fed. What happens after the Fed, though? Is this kind of we've already priced this in, this is a big nothing burger in 24 hours' time?
The market's anticipating some quite big moves. So buckle up. Could be an interesting afternoon.
Okay.
Interesting evening.
An interesting evening, European time, absolutely. Right, as ever. Let's get back to the European stories and tell you what's coming up on the programme. Coming up, we'll be talking about Spain once again. We did a lot of this yesterday, but the banking news takes us there again. BBVA tells Sabadell that it's interested in exploring an acquisition in what could be one of the largest European banking deals in years. We will get you the details. Plus, we'll look ahead to the UK local elections. They're taking place tomorrow. They could prove critical for Rishi Sunak's premiership. We'll find out why. That conversation shortly. If you have any questions, if you want to get get involved in any of the conversations, there's a lot to talk about this morning in terms of the Fed and earnings. IB plus TV Go, that is the function you need on the Bloomberg terminal. This is Bloomberg.
On inflation, I mean, I think, of course, the Fed's heart is in the right place, but it's hard to be a island of technocratic tranquility in the middle of a sea of political turmoil. The Fed is independent, but, you know, the governors get appointed, the Fed chair gets appointed.
An island of technocratic tranquility. Do you think he thought about that for a long time? Certainly sounds like it. Ken Rogoff, there, of course, Harvard University professor of economics and chair of international economics. The Fed is the story today. In so many ways, it is the story, but we also get, as Critty's been pointing out today, the funding requirements coming out of the US government, which are likely to be substantial. And it speaks to the interplay that Ken is hinting at in terms of what is happening here with the US economy and how that fiscal impulse is impacting the economy, which is impacting what is happening with the Fed decisions. Freya Beamish, TS Lombard chief economist, joins us now. Morning. Nice to see you in the studio, by the way, first of all.
Yeah, thank you.
What do you expect?
From the Fed?
Fed, yeah.
Yeah, obviously from the Fed. I think it's unlikely that we see any kind of major shifts on rates at this stage. I think June is probably still too soon, given the run of upside.
You still think they're in cutting mode?
Yeah, I do. I think they're not. We're not going to hear anything necessarily to that in that direction today. Just because we've had that run of upside surprises, and you get 3 in a row, and you can't really continue to use the word idiosyncratic. You have to have a very, kind of strong reason as to why you think there's some underlying risk of inflation coming back down again, and the trend actually being lower, which I happen to have. But I think the Fed can't really come out today and kind of speak along those lines. So today is too soon to say that, and June is probably too soon for the first cut. But when I look at the breakdowns of January, February and March, I can still use the word idiosyncratic, and I do still think that the supply is responding to demand. So when I look at the breakdowns from those three months of upside surprises, I see shelter, but I see a lot of the kind of the more volatile aspects of shelter jumping up. So it's not the stuff that's banked on primary rents, which continues to look like it's on a disinflationary trend. I see a lot of energy filtering through into core through transportation services, which is a sector that has been very badly affected by the pandemic. They're trying to rebuild themselves, and so whenever they get the chance to push up prices again, they do that, but they can't necessarily do that unless oil continues to rise. So that kind of energy spillover into core is there, and I see a lot of kind of in the details that you can sort of explain it away. Now, you can't do that continuously, and I'm almost getting a little bit uncomfortable about doing it 3 months in a row. But I do see not so much supply-led demand, but I see not so much supply-led growth, but I see demand leading supply back on. So we see immigration recovering, and we see very strong productivity growth. And that's actually quite a positive story, kind of from a bigger picture perspective.
So you think productivity is going to deliver? I mean, so what is the trajectory? Big picture then, Freya, stepping away from the detailed 3 months inflation reports. What is the trajectory for the economy? Does it continue to impress as it has done?
So within a 12-month period, I have kind of 2 types of analysis that I like to do. One is the sort of the bigger picture liquidity type of analysis, and one is the shorter term leading indicators and coincident indicators. And those 2 things are actually telling me separate things at the moment. So that means a lot of volatility for one thing. But the bigger picture analysis is telling me this is a very resilient economy. There's still a lot of, going back to the fiscal story, going back to there being continued liquidity in the system that still has to be absorbed into real growth, still has to be absorbed into prices, money still having the capability of turning over more rapidly. That all speaks to a resilient economy. But what I think is perhaps underappreciated at the moment is the leading indicators pointing to a wobble in the labour market. Okay. So actually, when you put together what I'm saying for the short term, I'm saying kind of 3% inflation, not 4% inflation as we had in Q1. And I'm also saying some of the leading indicators in the next kind of 3 months or so are pointing to downside surprises in the jobs market as well. Which
okay, so we look for some wobbles on the labour market, and you think inflation comes lower in the second quarter. So that sounds as if the Fed could move towards cutting by the end of the year, to your view. So what will Powell say, do you think, today when he's asked whether the dots are still valid, as Guy was saying in the last part of the programme?
I think at this stage, when you're sitting in the position of being the chair, you can't really look at 3 back-to-back prints of upside surprises and sound too sanguine. I don't think he's going to want to scare markets. I think markets are already kind of a little bit they're looking in that direction. There's a sort of a alliance of people that believe in this kind of higher pressure economy that could actually be quite a good thing for productivity growth, and that means higher average inflation, and those people are sort of lining up with the people that are worried about inflation moving into a second wave. And I think that markets are being dictated by that alliance at the moment, and Powell can let that run for a little bit. But I think if we do get inflation kind of surprising on the downside over kind of Q2, especially if we then start to get this array of leading indicators now on the jobs market coming through into the hard data, then that will be a time for them to say, OK, well, inflation is coming down. It's not coming down to 2%. I want to make that clear. I think it could come down to 3%. But it's coming in the right direction, and jobs are wobbling.
Freya, should the folks at the FOMC be worried about a 2-year yield and potentially even a 10-year yield that is sustainably above 5%? Is that a line in the sand that might freak them out?
I think that's where it's going over the longer term. I think on a secular basis, there are good reasons to believe that a 5% bond yield is sustainable, and perhaps even at that rate, it wouldn't be a fair compensation to people over the period of the 10 years. I think we've got higher risks hitting the economy. We've got a greater likelihood of supply-side shocks. That means there should be higher term premium because bonds are less of a good hedge against equities. I think we've probably got higher wage growth on a secular basis, which I don't think is necessarily a negative thing. I think that can be if it's contained and there's no kind of spiraling property, which I don't see.
So what is then the ripple effect of basically what the markets are doing, which is front-running the Federal Reserve? What is the ripple effect into the real economy?
I think into the real economy at the moment, there's still a portion of the economy that is running on the previous stimulus. That is the 40 to 60% part of the income distribution. When I look at them and I look at the money they have in their bank account, it looks like they still have enough money. So I'm not so much a fan of the idea of the excess savings and how much savings are left over, but I can look at how much money they've got left compared with how much money they're used to having in their bank account compared with their income and expenditure, and that still looks quite strong. Where I'm more worried is in the lower income parts of the distribution, and in the smaller business sector, which is not so much picked up by markets, where we're starting to see signs, perhaps again going back to those survey data, that there is a response finally to high interest rates, and that's where the wobble is coming from.
All right, Freya Beamish, TS Lombard's chief economist, walking us through how she's viewing the U.S. economic story ahead of that federal decision later today. Coming up on the program, we switch over to the U.K. Prime Minister Rishi Sunak facing another major test as England prepares for local elections. We're going to have a preview of Thursday's vote next, what this means, why we should care, plus some of the data that we are watching on the U.K. front as well. We will have full market pricing as those European markets remain closed as well. There's plenty more to digest. We're going to talk about the corporate stories. We're going to talk about, of course, more on the Federal Reserve. That seems to be the hot topic today. And, of course, the Treasury. There is a lot. Don't tune out. Stick with us. This is Bloomberg.
Rishi Sunak is facing another major test just months before an expected general election. Right-wing critics from within his own Conservative Party are gearing up to use Thursday's local votes as their final chance to oust him. That's if dire poll ratings translate to heavy losses. Voting will take place for more than 2,600 seats in over 100 local authorities in England. That's in addition to 10 mayoral races, including in the capital, and a parliamentary by-election in Blackpool South. Now, Conservative eyes here in Westminster are going to be fixed on two results in particular, as the outcome of the mayoral race in the West Midlands and that in Tees Valley. Those areas are emblematic of the party's ability to perform in Labour-facing regions. Lose them both, and Rishi Sunak could face a leadership challenge from within his own party.
I think the best that the Conservatives can hope for is damage limitation. But certainly in recent polls that we've seen from the public's perspective, Ipsos polling shows that there's actually quite little appetite for another Conservative leadership change at this point.
Labour will be keen to show that they can match sky-high expectations with results at the ballot box. The Prime Minister will want to emphasise that local elections are a very different beast to a general election. Whether that'll be enough to convince rebels within his own party, we'll find out once the votes are counted.
That's Bloomberg's Alex Morgan there on how the UK's local elections on Thursday could impact the general election later this year, could impact the timing of it. Let's talk about that with Bloomberg UK correspondent Lizzie Burton, who's here with us in studio. Lizzie, good morning. So we've got council elections, mayoral elections, all of that adds up to a lot of testing of the current leadership. Can the Conservatives hold on to councils that they control then in some of these key battlegrounds?
Well, the kind of bar for success that the Conservatives have set rests on two elements. First of all, can they hold on to about half of the roughly 1,000 seats that they won in the 2021 council elections? And secondly, as Alex put it well, can they hold on to those two key mayoral seats, Andy Street in the West Midlands and Ben Houchin in Tees Valley, because they represent the Tories' ability to fight in Labour-facing areas. Actually, YouGov polling suggests that Houchin and Street are going to cling on in these elections, but it could still be a bloodbath on point one.
OK, so say we get point one not working in their favour. What does it mean for the Labour Party? Is this confirmation of current polling that they are on track for a significant win when the general election comes?
Well, I reckon if they manage to do well, the message will still be from Labour. We cannot be complacent when it comes to the general election, but it's going to put wind in their sails, no doubt. Sunak hasn't been able to dent that poll lead. 20 points it is at the moment. And the truth is, Sunak hasn't been able to sustain a positive news cycle since he got into number 10, even if his advisors are telling us last week was his best week in office. It's just not something he's been able to keep up. And Keir Starmer's just had another boost from the SNP, from Humza Yousaf, the First Minister of Scotland, resigning, leaving the SNP rudderless and opening the door to much more of a victory for Labour north of the border when it does come to that general election.
Is there a catalyst here or a potential catalyst here for the Tories in terms of some sort of vote of no confidence?
Well, you'd have to have 50 votes from Tory rebels to get that confidence vote in Rishi Sunak. So it's dangerous territory for him. The critics have been eyeing this moment after the local elections as the point at which they could say there's no choice but to change leader if we want to avoid wipeout at the general. But look, as Alex put it there, they've already had 3 leaders since Boris Johnson in the 2019 general election. It's tricky to have yet another one before they go to the national polls.
And will they have time for that? Will Thursday determine when Sunak decides to go for the general election? Is it later in the year? There's some talk of July.
There's talk of July, but Sunak wouldn't confirm it when he was on the broadcast round on Sunday.
Yep.
At the moment, the working assumption is autumn. Why on earth would you want to go in the summer when Brits are going on their holidays?
Lizzie, thanks very much. Lizzie Burton with the latest on UK politics. Certainly something we'll be watching closely tomorrow when voters in much of England go to the polls for those local elections. Let's get UK stocks to watch then. It is UK focus, of course, because a lot of Europe is closed today. Joe Easton from our equities team has a briefing. Good morning, Joe.
Morning, Anna. So we're starting with a bit of a bellwether out of the UK High Street. We've got an update from Next today, and they are giving a little bit of a warning on some of their sales outlooks. They do actually say that while their full price sales did rise over the past quarter, they do expect a decline in the second half of the year. They actually say that this will be weather driven, as they think that the weather last year was much better than it is currently, and that will impact their sales according to the company. So a bit of a weather forecast from them as well. If we look at this stock, though, up 11% year to date, outperforming the broader UK retail market. One of the better performers. We can see it gaining more than the likes of AB Foods, the owner of Primark, and we can see M&S and Frasers continue to be weighed down by the cost of living concerns. And that's what we've seen over the past couple of years. If we look at a longer-term chart, we can see that retailers still have a long way to go in terms of making up the ground they've lost since the interest rates started going up. But that is also a European problem as well. This is the stocks retail index and the FTSE retail index together, both underperforming that broader market. Then, in terms of healthcare, we're going to look at GlaxoSmithKline and also Haleon, the consumer health business that they spun out a couple of years ago. In terms of GSK, they are raising their profit view very slightly. This is due to strength in HIV, oncology and infectious diseases. Sales could grow as much as 10%, according to the company, and they already raised their forecast back in January, so it's another boost for them. Haleon, meanwhile, a little bit of a sales decline for that one. It's the maker of Panadol and other paracetamol drugs, things you get in the chemist, but as we can see, analysts still like this one. 11 buys, only 1 sell, and expected to regain some of the ground since that IPO a few years back. Then, in terms of flashy cars, we've got Aston Martin. It's not a great one from these guys. It does look like revenue looks a little bit weak in the latest quarter. They are saying that the new rollouts of some of their models will help them rebound in the second half of the year, according to the company. Here's a few of the bullets on the screen. Their revenue down 9.5%. The pre-tax loss, a massive increase, 140 million almost in pre-tax loss for the quarter. But those 4 new models should potentially drive growth. If we look at this stock, it's having another rough year. It is down 34% already year to date. And a reminder for any of those long-suffering, long-term shareholders, since it IPO'd back in 2019, it's a nasty-looking chart, that one. It's down 94%. Another weak results from them, but potentially those new models might give some relief today.
Brutal carnage in that stock. Our equities reporter Joe Easton there walking us through some of the stocks to watch. We thank you so much. Coming up on the program, another major stock we're going to be watching out of the States. Amazon shares jumping after the bell yesterday, reporting strong cloud unit sales on rising AI demand. The consumer unit, though, significantly weaker. We'll have that story for you next. This is Bloomberg.
The Fed decides.
Jake Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Welcome back to Markets Today. We have 19 minutes until the start of cash equities trading, and the futures picture, well, it's just the FTSE futures we're showing you this morning. Fairly flat, entirely flat, nothing to see here, really. US futures are flat to negative. Nasdaq futures down 0.5%. And this is where the action is really today, because a lot of Europe is closed, a lot of the Asian markets closed as well. But it is Fed Day, so there's plenty to talk about. Joining us now is Bloomberg Market Live's Ven Ram, here with us to talk about the markets in a couple of minutes. Ven, let's start with the Fed then. We've been having some interesting conversations. You know, do we need to hear new messaging from Jerome Powell today around how much comfort or lack of comfort they got from the inflation prints earlier on this year with regards to rate cuts? Or have we already heard that from the Fed over the last couple of weeks?
Yes, so we are going to get a reiteration of that message, Anna. So it's May Day, and it's May Day for the Fed, because they are quite in a fair bit of distress here. Inexplicably, in December last year, the Fed turned uber dovish and penciled in 3 rate cuts for 2024. They had an opportunity to redeem themselves in March, but what did they do? They said that inflation was going to be higher, the economy is going to be performing a lot stronger, and yet they penciled in 3 rate cuts for 2024. Now, since then, inflation hasn't quite gone to script. The core PCE is averaging almost 3% this year. That is much higher than the Fed's 2.6% that they've penciled in. So inflation is clearly not cooperating, which means that Powell really doesn't have any choice today but to sound hawkish. Mind you, we do not get any summary of economic projections today, nor do we get a dot plot. So it will come down to Powell's signaling solely from his press conference today.
OK, so you say it's May Day. I mean, others would argue it's a nice problem to have when the economy is doing better than you had anticipated. But I know that's not the whole story, Ven. We've seen, as a result of this higher for longer expectation, then, investors perhaps growing bearish on treasuries, yields on the rise. You think that's set to continue?
Yeah, that is likely to continue. If you look at bearish positioning on treasuries, it's the highest we have seen in a long while. And that may continue with Powell's messaging expected today. I mean, two-year yields, we've done a lot on two-year yields in the past month, but we are likely to see the yield go up to 5.22% on the two-year maturity if the markets price out the one rate cut that they are now expecting. I think that is possible, that is likely perhaps, but not immediately today. So there may be some profit taking on the back of Fed today.
Ben, thanks so much. Ben Ram from our Markets Live team. Thank you very much for joining us with thoughts on the markets. You can get more insight analysis from the Markets Live crew. MLIV Go is the function to use on the Bloomberg terminal to find thoughts from Ben and Mark and the team.
Let's go to the corporate news now. Let's talk a little bit about Amazon. Its cloud unit has seen its strongest sales growth in a year. Last year wasn't good. This year we're certainly bouncing back. So we are certainly seeing a turnaround there. That's the most profitable division. However, other things not looking quite so clever. On an earnings call last night, Andy Jassy, the CEO, said Amazon's AI capabilities are behind the re-acceleration in growth.
We see considerable momentum on the AI front, where we've accumulated a multi-billion-dollar revenue run rate already. You've heard me talk about our approach before, and we continue to add capabilities at all three layers of the Gen AI stack.
Charlie Wells joins us now to kind of walk us through what we've seen. Kind of a split story here. So let's start with the AI. The AI story was always going to be a big focus. We were looking for its impact into the cloud business. We are seeing evidence of that. Cloud is coming back. How much of the cloud comeback is AI, and how much of it is just cloud is coming back?
Yeah, so a huge part of this was what was AI. And what Wall Street wanted was for Amazon to be able to talk about the future. Not just what they did in cloud, not just what they did in AI in Q1, but what they were going to do going forward. How are they going to monetize this? And what was really striking was that executives for the first time publicly put a revenue run rate to that AI franchise. So Brian Olsavsky yesterday said this was $1 million run rate business. Oh, sorry, I'm sorry, multi-billion dollar. Yeah, not enough. Multi-billion dollar run rate business, and that is something that Wall Street wanted. What they've really been doing with these mega tech companies is they've been punishing companies that tell a kind of muddled story. So I'm thinking about Meta, and they have been boosting companies that can tell that positive future story. So AI crucial here.
Except AWS, their cloud unit, it's only like a third of their business. And it's so interesting to me that the stock is trading as if it's a tech stock when it's really a consumer stock.
Yeah, I mean, let's talk about some of the softness that we saw as far as e-commerce sales. And so this was really interesting, and this was almost kind of more of an inflation story. So Olsavsky was saying yesterday that consumers seem to be trading down. So they're spending less on some of these products. They're buying more consumables. So those are more expensive for Amazon to deliver. So there was softness there. But it was interesting, you know, this was the first earnings report where we also saw ads in Amazon Prime reflected, and that was striking. So that was sort of a positive story. Ad revenue up 24%. So softness on that consumer side, but some diversity as well in this huge conglomerate.
Yeah, it is huge. The consumer side important, as you say. Back to the tech side of things and the AI race. I mean, all of these big tech giants are trying to find their place within the AI story. I was drawn to the lines around this being a Swiss Army knife strategy. So they argue that customers can run all kinds of AI models with one cloud provider. So that's the sort of player that they want to be. What do the earnings then in big tech tell us about the state of this AI race then, Charlie?
Fiercely competitive, but as you say, it's kind of diversifying, right? So they don't have that kind of Microsoft whiz-bang chatbot that everybody's talking about. They have been doing more of a corporate play here. They're saying that they're going to be investing $150 billion, not million, billion dollars in data centers that would support AI, and they were able to support that investment thesis and that decision with this story about the future, and that future-oriented narrative was so crucial, and it seems like Wall Street's going to like this. In extended trading yesterday, Amazon shares were up 2%. But let's see what happens when that market opens.
Charlie, great to see you. Thanks for stopping by. Charlie Wells joining us on what's happening with Amazon. We also got AMD yesterday.
Yeah.
What I thought was interesting about AMD is the market didn't look at the AI stuff, which was actually all right. It actually looked at everything else, which wasn't all right, and marked the stock down on the back of that. Supermicro also really high expectations, didn't deliver on those. So it's not across the board that the AI story is.
And I thought it was interesting. Charlie was rightly pointing to the more clarity we've got on the revenue side of things and what AI delivers there. But there wasn't a huge amount of clarity on the amount of capex they're going to do. And in other times, with other tech names, that's been something that's really speaks to investors when there's big capex numbers being talked about without, you know, the necessary detail. They just talked about increasing capex meaningfully with regards to AI, which could mean anything.
Well, this is where I think the momentum trade kind of comes to falter a little bit, right? Because people are starting to have a little bit more of a nuanced approach of which companies, specifically in the chip space, can actually capitalize on it. Remember when AMD rallied just because Meta said it was powering the metaverse with AMD chips, and that itself made up the bulk of AMD's rally pre-NVIDIA rally? And I think that's really interesting when it comes to the momentum story, because now you really have to look at the nuances of how each company is built, what their supply chain looks like, how exposed they are to the different types of markets. It gets very nerdy very quickly. I'm obsessed with The Chip War. It's a book.
Can I just say as well that no dividend, no buyback. Exactly. This is a company that has consistently over the years reinvested all of its money back into the business, and there was some expectation, and I wonder whether this is part of the share price story that we're going to see later on today. There was some expectation that maybe, just maybe, there was a possibility that would happen this time round. A lot of cold water poured on that.
But there is when tech companies in particular invest in R&D, there is a tax break that comes with that. Apple's famous for doing this, where they reinvest in their R&D division and don't have to pay taxes on that because it's kind of an innovative credit. I'm curious how much of the geopolitical and the chip situation from the Biden administration helps out with that. Another one of my obsessions.
Pretty's taking us back to the days before.
I get so nerdy. I only have so much memory to rely on. Let's more Creedy's obsessions.
AWS can help you with that.
Yeah, exactly.
More Creedy's obsessions. Let's talk about the Spanish banking giant. That seems to be the trend this morning. BBVA has proposed a takeover of lender Sabadell in what could be one of the largest European banking deals in years. I want to get more on the story. Bloomberg's Tom Metcalf has it all. Tom, we're talking about the largest European banking deal in years. I don't think Spanish banking. It's not the first thing that comes to mind. Walk us through why this deal might even be coming to the forefront.
Yeah, well, in terms of in Spain, part of the reason is BBVA have a lot of cash. And they actually came and tried to buy Sabadell back in 2020. And effectively, the rationale for that is this push for scale, especially as this interest rate margin sort of starts to decline. It's a real sort of generator of, I guess, deal demand. So we're seeing this as maybe a sign that, those animal spirits around deal making is perhaps coming back. And the Spanish market is indeed, it's maybe not people's first thoughts, but there's a huge consolidation opportunity within the market because, in the global financial crisis, I think it was something like 60 banks. Now that's down to around 10, and there's still, scope for more.
Yeah, we've seen a lot of consolidation within Spain already, as you say, and you do some nice maths and you add up BBVA and Sabadell and you get to, something about the same size as Santander, so you can see the rationale. Is that enough to bring shareholders on board then, Tom?
Well, it's really entertaining looking at the shares yesterday, right? You had Sabadell shares shoot up and by about 7-8% at one point, and BBVA shares fall by about the same amount. So you can kind of see which side of the shareholders are taking. And I'll go back to, I think, one of Critty's favourite points of buybacks. This probably does throw up, can BBVA continue to sort of really focus on capital distribution? Certainly not if they pursue a deal like this. So, yeah, it'll be interesting to see what happens over the next few days.
Can they raise the price without making it problematic? Is that going to be something that we're going to have to watch out for, i.e. this is it? How big a cost-cutting story could this ultimately be? Is the government going to be comfortable with this? Are we going to see a significant amount of branch closures, lots of layoffs? Kind of what are the fallout effects of this? And is the price about as far as we can go?
So the price is probably the most interesting thing here for me, because back in 2020, when BBVA went to Sabadell, we understand they were probably bidding, in the low billions. So, I think they initially came with 2.5 billion euros. Now Sabadell's share price or market value is 10. So, if you're sort of worried about penny pinching as a chairman of BBVA, you're probably like, wow, we're just going to pay another 7 billion 3 years on. Obviously, Sabadell's, transformed since then, so there is a case for it. And then I think, as ever with these big mergers, that's absolutely the thing, kind of the risks to this deal, right? If it does go through, big if there. But then will Madrid really want to sort of see it through? As you say, two big names in the domestic banking scene, and we've seen it before. Lots of job cuts, branch closes, big top political issue wherever you go, and that will be a massive hurdle as well.
The street commentary was interesting on this one because even though I think this came out at the actual pricing of it or potential price that came out at like 10 a.m. or 2 p.m. or something like that yesterday. And then the Wall Street commentary off the back of it was that this is significantly lower when they expect. So, or significantly lower in terms of share price, and then the markets are closed today. So we don't actually see an immediate reaction to these takeover talks until tomorrow, I guess.
No, not even tomorrow.
A little bit of a delay.
Spain's also closed tomorrow.
Oh, so amazing.
Which is partly
They're getting
why...
ready for you, Critty. So basically, Critty's going on holiday. Spain is getting ready for Critty's arrival.
There we go.
Excellent.
And this news will break when I'm on holiday, and I'm going to be so annoyed. I will be sending emails from my vacation. Anyways, Bloomberg's Tom Metcalf will be filling in on the Spanish obsession when I am gone. We thank you so much for joining the program. It's fascinating, though, because it's coming at a time. We talked to Santander and CaixaBank yesterday about this outperformance. Consolidation happens at the best of times and the worst of times, right? Which is it for Spain?
Well, it's pretty good times, I suppose, in terms of how the Spanish economy is doing. But it also happens maybe domestically when you can't do it cross-border.
Well, so I think that's the point here, which is that you can still see domestic deals being done in Europe. You just can't see cross-border deals. But domestic deals are getting harder because you've got to take out a lot of costs and lay off a lot of people.
And you've done a lot of them already, to Tom's point.
Precisely. Yeah. So Spain had loads of them during the crisis. If you remember the kind of the crisis that happened in the Caixa banks, and what happened there was obviously hugely significant and it's had a lasting effect. But here we still are. We're talking about Capital Markets Union. This is a domestic deal. This is not the kind of deal ultimately I think kind of regulators, politicians are hoping will happen. You get bigger banks in Europe, they have greater scale, they have greater capacity. This is not one of those transactions.
And we should mention Pedro Sanchez has already been very tough on the corporate space. He's not exactly the most business-friendly leader at the moment. There's some kind of regional politics to be kept in mind, especially with Banco Bilbao, of course, being kind of a different part of the country. There's plenty more to digest. That is the Spanish story, but of course we're going to go right back to those UK earnings and how they are received at that market open. FTSE 100 futures doing a whole lot of nothing at the moment. We're hoping things will be a little bit more exciting in about 5 minutes' time. We are going to break it down for you. The UK market open coming up next. This is Bloomberg.
Wednesday, the 1st of May. It is May Day. Most of Europe is closed. Some of Europe is closed tomorrow as well, as we just learned. Spain is having a 2-day holiday, which is very nice for them. We should be off on Monday here in the UK, but we are open today. And, well, I say we're open. We're opening in about 1 minute, 40 seconds. The Danes are going to be joining us as well, I understand. So you may see a price on Maersk, you may see on Vestas, and, of course, on Novo Nordisk. But here in the UK, we're looking at pharma stocks in a different way. GSK is out with numbers this morning, raising its guidance and expected to see a pop at the get-go of trade this morning.
Right, yeah, the GSK story is very interesting. Raising the guidance, as you say. I was just looking at the info from Bloomberg Intelligence, though. They're calling it a minor guidance increase, which looks conservative. So still gives it the ability to raise later in the year. So we'll see how much the market goes along with the sort of pricing things in the short term.
For me, it's Aston Martin. I'm putting my Guy Johnson hat/tie on.
Cool.
When it comes to Aston Martin. The weakness is really interesting in the car makers. I know we kind of talk about that a lot, but this pricing difference is almost more acute when you look at the stock market.
So the cars have actually done reasonably well so far this year. If you take a look at the performance recently, it's been okay. I think I do find it fascinating we're now starting to see some cracks starting to appear at the top end of the market. And that premium pricing. It tells me that the portion of the consumer that we thought was strong is starting to have second thoughts. And I think that is something that you want to pay attention to, because the lower income quartiles are starting to show weakness. If that creeps up the income scale, you want to pay attention to that. Now, Aston Martin's kind of right at the top of the income scale, but nevertheless.
So there's that trouble there, trouble at the place where people buy $6 lattes as well. I'm not sure if that's the same market.
I take that to heart. That is a very challenging part of my day.
Would you drink a lavender latte?
No, because I don't like lavender, but I love the concept of it. It sounds lovely. There's
really?
there's an
I'm
alliteration.
not sure anyone should consume it. If you missed the top of the programme, that'll make no sense. That was in reference to the numbers out of Starbucks. But European equity markets are open. I should just say UK and Danish markets and a couple. You know, that's the major markets that are going to be open in Europe. Actually, the Danish market is open then and moving lower this morning. It seems it actually really outperformed yesterday, which I hadn't noticed until this point. The FTSE 100
that was Eli Lilly.
Is there we are. The FTSE 100 is up 1/10 0.2% this morning, so a little bit of movement at the start of trade. Looking for some movement in GSK. We do have a little bit of a move higher, just up 0.2%. We've talked about that one and the numbers we got there. We're also looking for what we get out of Next. This often seen as a bellwether of the UK consumer, and they talked quite positively, but they've left their guidance unchanged. They'd previously given us some quite positive lines around what real wages, higher real wages in the UK will do to their customer base. Well,
speaking of GSK, Haleon, one of your worst
really
performing.
Soft,
coming in about 2%. A couple of things here. It looks like we are seeing that first quarter volume. So we pointed out their operating margin when we initially got these numbers, because that did come in hot, 24.2%, the estimate 23%. Looks like you're seeing some of the analyst commentary here saying there was a volume miss, Citi specifically saying that there could spur some derating. They're also talking about a pre-tax profit rise, which is positive, but ultimately coming off of a revenue drop. So there's, again, questions about sustainability there. Right now, one of your high volume movers, and down about, we'll call it about 2%, is kind of moving quite a bit. But one of your biggest index weights this morning on the FTSE 100.
I want to see what Wix is doing. This is not a company I talk about on a regular basis. If you don't know, it does kind of bathrooms and kitchens and things like that. But it looks soft this morning. And I bring this up in the context of the fact that we've got house price data out this morning as well that is showing some weakness too in the UK. The rate story keeps repricing, and it's repricing upwards at the moment. So people are really kind of... I think people are really struggling to figure out what's happening with the mortgage market.
Absolutely. We spoke to the Barclays CEO just last week, didn't we? And he said we've been on a sort of round trip with 90 basis points down and 90 basis points up in terms of gilt pricing, and that reflects that same story. And we have seen some mortgage providers in the UK, to your point, Guy, actually increasing their rates for mortgages in recent weeks.
No kitchens.
No, we're getting an insight into the way Guy Johnson spends his weekends, I think.
Well, when you said Wix, I was like, is this Wix.com, like the web creator?
No, I don't think you've ever been in a Wix.
No, I don't know what a Wix is.
I don't think you need
even if I did, I don't cook, so I can't, like, I have no use for it. But anyways, that's what we're learning about Crady today. Someone else talk.
OK, let's go back to the macro story, shall we? The overall story this morning is, of course, we're waiting for the Fed. We're waiting for the Fed's Powell to speak a little bit later and tell us, perhaps, how relevant those dot plots are still to market expectations around how many rate cuts we get in 2024. We had an interesting conversation, though, yesterday with one guest who was with us on set, who was saying that actually it's Janet Yellen you need to listen to a lot. Such has been the role of fiscal policy in the US economic outperformers rather than the Fed. With that in mind, we thought we'd dig into a little bit of what Janet Yellen is concerned about right now when it comes to the deficit.
I do have concern about where we're going unless we undertake some significant steps to reduce the budget deficit.
US Treasury Secretary Janet Yellen there. Joining us now, Maria Monici, who is fund manager at M&G Investments. Really good to see you this morning, Maria. Thank you for joining us on what is a quiet day for much of Europe, but the UK market's still open and we're still here. And we're waiting for the Fed, of course, a little bit later on today. So we talked a little bit about what the Fed's messaging is going to be today. We've already heard from Powell that the inflation data at the beginning of the year did not give the comfort that they were looking for in terms of being able to start rate cutting. So what do you think the messaging will look like today from the Fed?
I think what we're still seeing is a central bank that is very, very data dependent, and the data is not necessarily following some of the predictions that were put in place 12 or 18 months ago. So they have to do a lot of balancing act to try and fit what the data is telling them with how the market is behaving. And this has led to quite a lot of change in not so much the trajectory of the policy, but actually the words and how this was communicated. So I think today the market is expecting again kind of a change in tone, something that might become a little bit more hawkish. This is what we're seeing in what has been priced across fixed income markets, with weakness really year to date, taking the yields, for example, on the short end of the curve, on the 2 years US, from a real yield perspective, a very, very high level at the moment. So I think what we will see is, yes, a shift in tone, something that will highlight more the recent data that we have seen. So still pressure from an inflation and wage growth standpoint. But at the same time, I believe that we won't have a clear direction of what things will look like between now and the end of the year, because data will still be changing.
OK, what do stocks do if we don't have a clear direction on the rate cut trajectory?
That's the big question, because obviously we have seen a positive inclination towards equities and risk assets since the beginning of the year. And this has been because, investors have been able to focus a lot more on positive growth data and a benign earnings environment, despite the slight more pressure from inflation not coming down as fast as expected, because the expectation on rate cuts has remained, again, quite benign. Now, should we get more pressure coming in from the rate environment, this might start to affect some of the equity markets as well and put some pressure in this space, which, again, we haven't seen so far this year. We have a slight hint of it at the beginning of April, when we started to see positive correlations across equities and bonds kicking in again. But there is a risk and a vulnerability there, especially as valuations are not particularly expensive, but they are relying on a strong economic background.
Seems to be a lot of uncertainty at the moment. What's the argument for coming out of cash?
It's a very good observation, and in fact our position is still to have a relatively elevated level of cash where real yields are still quite attractive, and where we continue to see a market that, yes, has shown signs of decorrelation across asset classes, but where positive correlations has a risk of coming back. And as multi-asset investors, that diversification across asset classes and decorrelation is very, very important. So having a slightly higher level of liquidity provides us with some level of interest in real yield and real returns, but at the same time the additional flexibility to react to markets should we have some interesting opportunities.
Does Europe keep doing well in the environment we're talking about here? Because there's uncertainty surrounding the Fed. Maybe the ECB can't go as far as maybe we anticipated. European growth is probably slowing significantly more than we're seeing over in the United States. It is slowing, or has slowed more than we've seen in the United States. There's some signs of a pickup. But is the current appetite for European stocks based on that economic pickup, or is it just a diversifier from the United States? If it's the former, if we don't see significant rate cuts, does it run out of steam?
Well, I think where you started in European markets was an environment where valuations were much cheaper than you've seen in the US, and so the starting point was much more favorable, and investors' beliefs were much more negative on Europe than they were in the US. So these also justify some of the strong returns that we've seen year to date in European markets. The growth picture is somehow slightly better than potentially anticipated, and so earnings. The big question is, if the Fed is not pushed to cut rates in the short term, what is the central banks in Europe is going to be? Obviously, the mandate is still very much focused on inflation. Inflation is getting closer to the target, but it's still not yet there yet. And there is the question of, relative currency values between dollar and euro, and what does it mean for the overall economy in Europe with a very strong dollar, as we've seen in the past few months.
Well, what does that mean? I mean, how much of a hit does that take then if you start to see the dollar climb? I mean, since post-COVID, it's just been on a downward trajectory. So in the broader scheme of things, it's actually not that strong, but it could be in the next 12 months. How does that factor into your positioning?
Well, if you have strong divergences in monetary policies coming up, you're probably going to have some more dislocation in currency markets and a slight pickup in volatility. However, I think, that you're still working very much with the global economy, with the majors are, heading in similar directions. They're not exactly, in the same place if you look at US versus Euro versus UK. But overall, they, in a way, also influence each other. So I think, currency plays an important role, but in a portfolio, I think, you want to think about what are you end clients' currency base and manage portfolio accordingly, and taking risks where it makes sense. For example, an area that we still like is actually emerging market currencies through emerging market local government bonds, where real yields are still elevated, currencies still offer quite interesting carry. But even in this space, we found that compared to the past, we like to be more diversified, so not taking strong bets in one particular currency at the moment.
Yeah, that's been a topic that we've been discussing quite a bit on the show in terms of dollar earners. Is that the play when it comes to European stocks? Which brings me, by the way, Starbucks as an example. She's wearing lavender, can I just point out? We've been talking a lot about
on message.
We've been talking a lot about lavender lattes this morning coming out of Starbucks, but to kind of hit on that theme, when you talk about the dollar earning story, so much of that is based on China exposure as well. How much are you factoring the China growth story, the Chinese consumption story, in the shadow, perhaps, of that U.S. economic resilience?
Well, I think what we've seen is that China has actually lagged a lot in terms of expectations for what concerns consumption and, in terms of fueling returns and earnings for US stocks. So actually what we've seen is, a more widespread exposure. I think what's interesting about China from an equity standpoint is that actually it has been a market that is very much unloved by investors. And, we entered the year in January where valuations were extremely, extremely low. We had earnings yield of 16 times in Chinese equities after a very strong period of underperformance. And that actually for us presented opportunities to start investing on some of these Chinese equity names. And since then, actually, what we've seen is a very strong re-rating in these markets, specifically in the last few weeks, and is one of the best performing market within emerging market equities at the moment. So we have seen sentiment turning very significant from a peak pessimism in January on Chinese equities and now a slightly better view. So from a tactical asset allocation standpoint, this has been a very interesting opportunity for us, something we've leaned in within the portfolios, and we're now starting to take some profits in this position, although I think from a valuation standpoint and a long-term perspective, Chinese equities can still represent an opportunity for investors.
OK, and that's interesting, and certainly in the short term, in the context of the lines we got from the Politburo yesterday around monetary policy. Thanks very much, Maria, for joining us. Good to speak to you. Thanks for coming in. Maria Monici, fund manager at M&G Investments. Let's get to some of the individual stocks on the move. Joe Easton has the list this morning. Joe, good morning.
So we got a big drop out of Aston Martin out the gates here in London. We're down 11% at the moment. We were down 14% at the open of trading. The company reporting a 26% decline in their vehicle sales in the last quarter. They do say that the rollout of the new Vantage and the new SUV will help them recover in the second half of the year, but the rollout of those vehicles not coming quick enough for the turnaround to accelerate under Lawrence Stroll. They do have a new CEO, but this stock now down 40% this year alone and adding to the massive losses since the IPO 5 years ago for AML this morning. We'll take a look at the UK retailers as well. We had those numbers out of Next. They did report sales up around 6% in the last quarter, but it's the commentary around the year ahead. The second half will be weaker than expected, partly due to the weather not as good. It's about 18 degrees today, so potentially people will start be getting out to Next and other retailers buying their summer wear. But we are seeing a feed through into some of the other peers today as well, like Marks and Spencer's, Frasers, ABF, the owner of Primark, all of those getting a bit of a dip this morning in lighter UK trading this morning. Then in terms of the UK healthcare stocks, we had GlaxoSmithKline. That one's seeing some small gains at the open today. Some of their Shingrix vaccines doing well, also HIV, oncology pretty strong, but the weak one is Haleon. Now, according to them, their pain relief sales are down around 9% in the last quarter. That sounds pretty good, but not if you're a maker of paracetamol, which is what they do, and their sales are coming down according to that report today. So that one down 1.7%. GSK still among the largest shareholders in Haleon as well, worth noting there. Then in terms of medical tech, we got numbers out of Smith & Nephew, a very solid earnings report from them this morning. 14 analysts with buy ratings, not a single sell on that one today, and their sales once again holding up pretty decent for Smith & Nephew, and we're gaining 1.9, almost 2% now for that one. Then a quick look at the home builders. We did have that data out of Nationwide that you mentioned earlier in the show. We are seeing a drop in house prices. According to them, it was the biggest drop in around 8 months. Those home builder shares pretty much holding up well this morning. Persimmon down 0.7%, but all of the others pretty much in the green. The interesting thing for me is people say that they aren't holding off from home purchases because of mortgage rates. It's the house prices being too high is what Nationwide is saying today. Finally, on that theme, one morning call for us today. We have got an upgrade for Travis Perkins. Guy mentioned Wickes earnings today, but Exane reckons you should be buying Travis Perkins shares. They predict a rebound in the UK construction sector. That's the building merchant firm here in London, and it's up 3.2% this morning.
The argument that it's house prices that are too high rather than the mortgage rates, I find that's an interesting way of approaching it. Presumably you've got to borrow, and the mortgage rate therefore determines how high house prices are. But anyway, we'll park that thought for the moment. Joe, thank you very much indeed. Coming up, we're going to talk more about those retailers next year. Off to a mixed start. The first quarter sales are rising, but the outlook, as Joe's just been pointing out, is really where the problem seems to lie, and that's rippling through the sector this morning. We'll find out why in more detail next. This is Bloomberg.
This is Markets Today, 8:18 here in London, and the FTSE 100 is open. Some other European markets, but most European markets are closed, of course, because it is a Labour Day holiday, 1st of May. But we do have trading here in London. For what it's worth, we're up by 0.1%. US futures actually pointing down 0.2% on E-minis, or 0.5% on Nasdaq futures. This after we saw some significant weakness in yesterday's session as well around Fed expectations. We're waiting for the Fed later. That's the big picture. Back to the micro stories. We're covering Next this morning. Next shares are trading lower this morning after the British retailer saw sales climb in the first quarter, but pointed to a likely weaker second quarter affected by colder than expected weather. Just yesterday was warm, but before that it was very cold
today.
And it's cold again today, so that was it. That was spring. Bloomberg's Jennifer Creary joins us this morning to talk us through the numbers. Jennifer, very nice to see you. So what do the results then tell us about consumer confidence? Let's start there, shall we? Is consumer confidence coming back?
Yeah, I mean, well, Next is off to a pretty good start, right? So sales are up 5.7%, and it beat its own estimate of 5% for the first quarter. So it's a pretty good start for Next. I think a lot of people will be looking at Next as some people will call it, a bellwether for the industry. I think more broadly, it's just kind of it's kind of leading the market at the moment. So what it tells us, everyone's looking for signs that inflation is easing and that's translating into growing consumer confidence. And so it shows us that the consumer is coming back, but it's not roaring back. Shoppers are still pinching their pennies.
Let's talk about the forecast. This sounds like a weather forecast to me, rather than a sales forecast. It does seem it's very weather dependent at the moment, as Anna points out. They're keeping their full year guidance intact, but they are kind of warning that the colder weather is having an impact on people's shopping habits.
Yeah, exactly. So it's forecasting that sales will be down 0.3% for the second quarter, and that's because it's got a pretty tough comparable to last year.
Right.
So last year, pretty warm weather. At the moment, it's pretty cold. I'm still wearing my coat. It's May. So that it just means that, people will be still holding on to their winter wear. They're not quite looking for spring wear yet. So that's why it hasn't given a pretty bullish forecast for the coming quarter.
I have to say, on the car ride this morning to work, I actively asked the Uber driver to turn up the temperature, and he actively rolled his eyes at me, so that was fun. Yeah. Talk to us about whether this is a Next story or if this is a broader retailer story. Are other retailers able to capitalize here?
Yeah, so, as I said, Next is considered to be, one of the best, if not the best retailer on the high street at the moment. It's got, very well-run stores. It's got a very impressive online operation, so much so that it's able to, share its know-how, its IT know-how, warehousing, logistics with other smaller rivals. So it's very much what works for Next might not work for other retailers. It's very much a leader in the market. So we're seeing kind of this bifurcation between companies that are able to do very well, like Next, and kind of the weaker rivals that are falling behind. So what works for Next might not work for others.
All right. Bloomberg's Jennifer Creary walking us through that retail story. Her first time on TV, by the way. I think she did great. Thank you so much for bringing that up for us. Now, as we're talking about the consumer story in the UK, we've got to talk about the consumer story, perhaps globally, with one of the biggest players, Amazon, of course, top of mind, but not necessarily for their e-commerce business. Their cloud unit seeing the strongest sales growth in over a year. It signals a turnaround for the retailer's most profitable division. Now, on an earnings call, CEO Andy Jassy said Amazon's AI capabilities are behind the reacceleration in the business's growth.
We see considerable momentum on the AI front, where we've accumulated a multi-billion-dollar revenue run rate already. You've heard me talk about our approach before, and we continue to add capabilities at all three layers of the Gen AI stack.
All right, we're joined now by Bloomberg's Charlie Wells. He's back. You again. Hello. Talk to us a little bit about this AI story. I mean, I think of Amazon as a consumer company. How's their AI business doing?
Yeah, so it's actually doing pretty well, it looks like. In the first quarter, revenue for AWS, where that AI franchise is housed, revenue was up 17%. So that's really positive. That's backward-looking. What investors have really wanted was that forward-looking story. They liked this story about the revenue run rate of this being a multi-billion-dollar business. So that's positive. And overall, we've just been hearing so much about AI, and what investors really want to know is, can you actually make money off of this? And it's looking like Amazon's able to do do this. And it's also looking like cloud is back. Businesses are willing to spend on that cloud infrastructure, and that all ties into this AI narrative.
Okay, so strong narrative coming through then on the cloud side, and within that, the AI activity that customers are doing on the cloud. Let's go back to the retail side of things. I mean, this is an area, Charlie, that during the pandemic really expanded and, in many people's view, over-expanded. They had to retreat from. So how is the rest of Amazon's business performing now?
Yeah, so Jassy has really been focusing a lot on profitability, right? He's been trying to make this at first it was a lot about speed. Now it's really focusing more on efficiency and profitability. And what was striking is a lot of people think about Amazon as an e-commerce company. E-commerce revenue actually missed expectations in yesterday's earnings call. And it's looking like consumers are starting to feel pressure, or continuing to feel pressure from inflation. They're buying more consumables. And so that was not great from this earnings call. But what was a little bit better, this was the first call where we saw ads in Amazon Prime reflected in the earnings, and ad revenue, at least on that front, was up 24%.
No dividend, no buyback. This is a company that is investing money back into its business. It's always done that traditionally. Does the bulk of the investment go into the AI story, or does it go into the wider business? You talk about kind of cost cuts. Are we going to see all of the investment, therefore, going into AI? Do the cost cuts continue?
Well, Guy, it's funny that you bring up dividends, because that actually came up on the earnings call yesterday. And the CFO was actually asked, where's your dividend? And other tech companies have been, for the first time, saying they're going to do dividends. Thinking about Meta here, I'm thinking about Alphabet. Amazon is the only big tech company that hasn't done a dividend. They haven't done share buybacks since 2022. The other tech mega caps have been doing buybacks, billions of dollars of buybacks. But also, as you say, Guy, Amazon says that it's really focused on investing in its business. And yesterday, the CFO was talking about how, they don't have news on buybacks, but they're sticking to their philosophy, which, as you say, is investing in that business to the tune of $150 billion in data centers, which we know are crucial for that AI. So at least right now, it's the reinvesting that cash, which could total $100 billion, according to some estimates this year, reinvesting a lot of that cash in the business.
Yeah, it is interesting when markets and investors choose to give these tech giants a break and say, sure, go spend that CapEx, and other times when they balk at that and say, no, we don't like the amount you're spending. You mentioned some figures there, which is interesting, because I was reading that they'd said that they were going to increase CapEx just meaningfully on AI, which didn't necessarily give the detail.
Yeah, I think there's a little bit of vagueness here, and I think the concern is that you get the Meta-style story, where in their earnings call, they talked about how they were going to spend more than expected investing in some of this infrastructure, and investors didn't like that. But what's really striking about Amazon is even without buybacks, even without that dividend, their stock has been performing really well. And just thinking even more short-term, yesterday in extended trading, Amazon was up 2%. So it's going to be really interesting to see what happens when the market opens in New York. Does that narrative continue, the positive narrative? Because with a lot of these big tech companies, when they've been able to tell a positive, future-oriented story, the markets have supported them. When it's been cloudier, thinking about Meta last week, you get a nosedive.
Cloudier. You did. Cloudier in a bad way, not cloudier in a good way.
Yes.
AWS was cloudy in a good way, but there we go. Thank you, Charlie, very much. Charlie Wells, getting to grips with the Amazon story for us and bringing us all the important stuff that you need to know. Coming up, we'll be back to the big macro story of the day. It is, of course, Fed Day. Not many changes are perhaps expected, certainly not a change in rates, but what are markets going to be looking out for when we hear from Jerome Powell a little bit later on? We don't get any dot plot today. We don't get their expectations around rates, but we will get to hear from Jerome Powell. So how will he talk about the number of cuts that are still expected, the validity of the most recent dot plot? What is that? We'll certainly talk about all of that when we come back. We'll get some expert US analysis. This is Bloomberg.
It's unlikely we see any kind of major shifts on rates at this stage. I think June is probably still too soon. What I think is perhaps underappreciated at the moment is the leading indicators pointing to a wobble in the labour market.
Okay.
So actually, when you put together what I'm saying for the short term, I'm saying kind of 3% inflation, not 4% inflation as we had in Q1. And I'm also saying some of the leading indicators in the next kind of 3 months or so are pointing to downside surprises in the jobs market as well.
A potential wobble in the labor market. Freya Beamish, their TS Lombard chief economist, walking us through what she's watching. Let's get another view here. Abigail Watt, U.S. economist over at UBS Investment Bank, joins us right here on set. So we heard from Freya there on what she's watching. What are you?
Yeah, so I think obviously we're expecting no change in the stance of monetary policy at today's Fed meeting. And I think we're expecting the statement to be kind of little changed as well. I think in the statement, the language around the stance of the economy, it still holds true. The kind of strength of the labour market, the idea that you've seen kind of quite robust growth, I think that still holds true. So we don't expect a huge amount of change there. And I just think that adds a little bit more emphasis onto Chair Powell's press conference and the prepared remarks that Chair Powell will give at the beginning of the press conference. So I think that's the kind of area of focus for today's Fed meeting. Obviously, we don't have any updated summary of economic projections at this meeting as well. So I think that just adds the emphasis to the communications from Chair Powell. I think that's going to be key today.
Such a big part of why tackling inflation in the first place is so important. Economics 101 is that affordability remains a question. If inflation is so high and wages don't catch up, then we have an issue. But wages are catching up. They might even be feeding the inflation. How big of a problem is inflation if wages are keeping the American consumer insulated to some extent?
Well, as you say there, you know, wages, there's kind of a push-pull here between wages and inflation. But I think the job of the FOMC is to try and, you know, keep the dual mandate. So they want to keep the labour market strong, but they also want to make sure that inflation returns sustainably back to that 2% target. And obviously yesterday we had the employment cost index out and it came in a little bit stronger than kind of we had expected and consensus had expected. And I think what you're seeing is kind of some stalling in the progress on inflation and some stalling perhaps in the progress there on the kind of wage data. And I think from the Fed's perspective, they'll be looking at that and thinking about that carefully in terms of their expectations for being able to kind of change monetary policy later this year, whether they can deliver the 3 cuts that are in their kind of March SEP.
If Bloomberg wasn't sending Mike McKee to the press conference and instead was sending Abigail Watt, what question would Abigail Watt ask in the press conference?
I think I would actually ask a question around that March SEP. In our preview for today's meeting, we noted that we think that if he was asked about this, it's something that the chair may comment on, that perhaps the kind of FOMC no longer sees 3 cuts as consistent this year. It's possible, though, that he continues to toe the data-dependent line instead. We'll see if the data evolves as we said in March, and if the data does evolve as we said in March, then that's still consistent. So I think it's going to be an interesting one to see his language around that 3-cut base case that was in the median. For what it's worth, our expectations are that we see 2 cuts from the Fed this year. We have the first cut penciled in for September, though, rather than June as we had originally expected.
If he wants to sound hawkish, how does he do it?
So there's a couple of places that we think, in terms of, if we look at the prepared remarks that Chair Powell had in the March FOMC press conference, there's so the 7th paragraph in those prepared remarks.
Very specifically.
Very
I'll be
specifically.
looking for it, Abigail.
There is some language around this idea that they can keep, you know, they'll keep rates on hold for longer if they need to, given inflation, and I think that language will likely remain. But the kind of language around the idea that the policy rate is at its peak for this tightening cycle, I think any changes, if that was to be removed or changes around that language, I think that would be a fairly hawkish signal from Chair Powell. But ultimately, we think that his language in the press conference and his prepared remarks will likely kind of stay very close to the language that we heard from him a couple of weeks ago around the kind of disappointment on the inflation data, the need to wait to have more confidence before being able to adjust monetary policy.
Abigail, do we get anything on the balance sheet? If this is a sort of watch and wait in other areas, do we get anything on the balance sheet this time?
Yeah, so in the March press conference, Chair Powell said that there was discussions at the March meeting and that there should be some changes coming fairly soon. That was the language that he used, and our interpretation of that was that we could see an announcement at the June meeting followed by implementation at the July meeting. you know, we could see some announcement of that today. You know, that's not our base case, but there could be some announcement of changes in their balance sheet policy today. Our base case is that the changes would be the runoff rate of treasuries is reduced to around 25 billion a month, and we're not expecting any changes on the MBS runoff rate. But as I said, it's not our base case that we hear that, but that could be something that is announced at today's
Back to
meeting.
Critty's point earlier about wages, and we got that employment index just yesterday. What is the 2024 real wages story in the US, do you think, Abigail? Because we've talked about that in the British context, actually, a little bit, with certain retailers talking about how that's going to be a boost for them. What's the story going to be around real wages in the US?
Yeah, so I think if you see a stalling on inflation, I think that's a less positive story. We have seen I think there's something that's maybe missed here in the kind of upside surprise we had on the wages data yesterday. The progress that we have seen, you know, a big part of that inflation story being able to come down has been that kind of normalization in wage growth. So I think our base case expectation is that we do continue to see progress on inflation, and alongside that, a big part of that story will be a continued normalization in wage rates. Because obviously the data that we had yesterday, given the level of productivity in the US, was inconsistent with that Fed 2% target. So I do think it will be something that we'll need to continue to see progress on throughout this year.
Well, if we do continue to see that progress, we see that normalization, how much or to what extent has the Fed kind of backed themselves in a corner here? If you see the data turn again, and this was indeed a transitory blip, dare I say, in the data, how hard is it for the Federal Reserve to kind of go back to perhaps some more of that dovish commentary, especially with the election in November?
Yeah, so I think the Fed will communicate and set its policy according to the data. They've been so clear that they're data dependent. So I think that you've seen that, you know, you've seen the acknowledgement that the inflation data through the first 3 months of the year has been disappointing. You know, you've seen them continuing to stay very focused on that data and use that data in their communications. So I do think that, you know, if you started to see the data rolling over, if you started to see kind of more disappointing data on the activity side, I do think that would be, you know, acknowledged as part of their communications in the same way that they've acknowledged that kind of disappointment on the inflation front.
Does the Fed need to bring stocks lower if it's going to get financial conditions to tighten? Are there other ways of doing it, but is that an easy way of doing it?
So, I mean, obviously the Fed, you know, when they're trying to control financial conditions, a big part of that is the communications that we were just discussing, right? Being able to kind of communicate a clear path for policy. And I think their ability to kind of do that it depends on that data. And I think that, you know, them communicating what's happening on the data front. We have seen, obviously, markets reacting quite strongly to the data as well. So I think, in part, the reaction to the data is actually a reaction, you know, to what the Fed, how the Fed might interpret that. Has
Powell done enough? Has the data done enough to unwind the financial conditions kicker that we got out of December when he pivoted then? Financial conditions eased pretty dramatically. Mm-hmm. To what extent has that unwound? It doesn't look like it to me. Does he need to do more on that front?
I don't think the Fed would be looking at markets explicitly. I'm not sure that's something that they're kind of targeting. I think what they're trying to do is continue to keep policy tight. And I think the way that they do that is by kind of holding the rate higher for longer. And I do think that's the narrative that's kind of obviously fed into markets recently and is growing more traction. You've seen that obviously in the shifting and the repricing of expectations for rate cuts this year. And I think again, I sound like a broken record here, but communication is key, right? I think at this point where they're holding rates higher for longer, the way that they communicate is going to be the tool that they use.
And we're working our way towards the jobs reports, aren't we, Abigail? What in the context of all that you've said about where the inflation story goes later in the year, what do you think the jobs report will show us? I'm just looking at the Waco function on the Bloomberg terminal. Tells me 240,000 jobs to be created or will have been created in the month of April and to be revealed on Friday. What are you expecting? That would be a downtick from 303,000, but it's still a big number.
Yeah, so we're actually a little bit below consensus in terms of the headline payrolls number. We're expecting 200,000 jobs to be added in April. We do see kind of two-sided risks to that. One of the things that we think has supported the strength in the payrolls numbers so far through the first quarter is the fact that we did see kind of very mild weather, and we do think that's likely supported jobs growth and maybe kept some seasonal workers in place. So we think that could be a possible downside risk on the print on Friday. I think the other element of it is seasonality. The seasonal adjustment in the data, getting a little bit nerdy here, but if we look at the seasonal adjustment factors, those have been they've been taking less off the kind of April prints in terms of the job flows. So that's one thing that could be a possible upside risk. But our base case is 200,000 jobs.
I'm sure somebody will ask the docs question. I'm sure somebody will ask about the SEP. Having watched you this morning, I'm sure that will now definitely happen. Abigail, great to see you. Thanks for stopping by. Abigail Watt, US economist, joining us from the UBS Investment Bank. Of course, don't miss our fantastic coverage, which is coming up a little bit later on. The coverage starts at 6:30 p.m. That's 1:30 p.m. New York time. The result obviously comes out initially at 2, 7, and then you get the press conference half an hour after that. Just trying to clear everything up, making sure you tune in at the right time. I would tune in early. It's fantastic
or
coverage.
Or just all day long.
You can tune in all day. Don't turn off. That is definitely the best strategy.
Good advice.
OK, coming up, we're going to talk about what is happening in the pharma sector. GSK having a good morning. This after reporting first quarter earnings. It did upgrade guidance. Is that a big upgrade to guidance? We're going to talk about that. We'll talk about what is happening with Novo later on this week. Sam Fazeli is going to be joining us. He's got some interesting things to say about rheumatoid arthritis as well. That's all coming up next. This is Bloomberg.
Today, the Fed decides.
Jay Powell pumping the brakes on rate cuts.
Hikes are off the table. No cuts looking perhaps a little bit more likely.
You can't say there's a whole lot wrong with the U.S. economy.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Our policy rate is likely at its peak.
The threshold to cut rates is a little higher.
We're redefining patience.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Morning, everybody. Welcome back. European markets are open. I say European markets are open. Basically, it's the Danes and us here in London that are at work today. Everybody else is taking Labour Day off. And the drug stocks are doing quite well in London. I take my glasses off to see what Astra's doing. It's adding the most points this morning. But GSK is the real standout story. The company out raising its profit forecast for the year. Beat in the first quarter. The British pharmaceutical giants predicting higher than expected sales on several key drugs, HIV, infectious diseases, oncology, some key areas in which this company is operating. Though the HIV story, 328, is going to be an interesting one that we should look at for this business. Sam Fazeli joins us now. He leads all our coverage in this space for Bloomberg Intelligence. Sam, there was a little bit of expectation that GSK would raise guidance, which has come as a surprise that they have. But how big a raise is this in terms of the guidance they're giving us?
Yeah, my colleague John Murphy, who's been covering the results, he's called it a minor raise.
Right.
And I think he thinks that they have more room, perhaps, in the second half. But the reality is that the big driver of growth, of revenues at least, and margins, would be this RSV vaccine, this new vaccine they have for treatment of prevention of respiratory infection. That comes in the second half. And that's going to be an interesting period to look at because they had a really strong, much more than they expected, much more than the market expected, period last year, sales last year. So that's what we're looking to see. But, you know, this company is on the verge of potentially margin expansion and obviously revenue growth going forward.
And good morning to you, Sam. Another one we're watching, apparently, according to our reports this morning, is the Blenrep and refiling of regulatory applications in the EU and the US around Blenrep, multiple myeloma treatment. This is something that had previously been filed for but had no luck, and so was sort of removed from financial models. Right. We're still watching that one?
Yeah, I'm not convinced analysts have put it back in their models or that focused on it. I think the company is treading a very fine line here in that the regulators withdrew it from the market because it failed a confirmatory trial, one that was, because it was approved on what's called an accelerated approval, a fast route in. But it's a drug that physicians want, doctors want it, because it gives them yet another option. So that's going to be interesting to see what the company says.
Let's talk about Eli Lilly here. Those numbers came out. If Novo Nordisk tomorrow, I believe. In terms of before we go into the actual numbers, these are the two kind of main competitors in the obesity market. Can you talk to us a little bit about kind of adoption rates of these drugs? Is there one that's ahead of the other?
Well, interesting. So there is a metric that people who are analyzing these companies on a nerdy level like us look at. It's called a new-to-brand prescriptions. It's a metric that's followed in the US, NBRX. So the NBRX for Zepbound, which is the Lilly drug, has overtaken, in terms of share of new-to-brand starts, basically, Wegovy. So they're getting more of the new patients that are coming on looking for a new obesity drug than Wegovy is. But we're talking just over 50%. So it's still a massively growing market. They're both growing into it. But Zepbound does have a better efficacy profile. And so that's what we all expected it to drive. And, of course, Novo is coming with yet another version of a drug that could potentially match Zepbound or beat it. Time will tell.
Is there a capacity story there? What does the actual production rate look like for both?
So I think their expectation is that possibly by next year, maybe 2026, but possibly by next year, they can actually start matching demand, because currently they're chasing a supply at the minute.
How much money are they leaving on the table?
Or, I mean, look, as much as they can make, they sell. So if you look at models...
Sure, but how much is demand? Is it possible to quantify the demand that's there and the supply that's there and how big that gap is?
So I'll give you a little hint of that, which is the way I look at it. They raised full-year revenues, this is Lilly, by about $2 billion. And that's all obesity, which is them feeling that, yes, we have solved, because there's lots of steps here. You need a pen, you need the drug, etc. They feel that they've solved some of the capacity issue for this year, a little bit more. That's given them confidence to raise by $2 billion. $2 billion. So if that gives you a sense... That's the sort of number we're looking at.
Does this tell us anything cautionary, Sam? I mean, this is obviously great news for those waiting for this particular drug. Is there anything cautionary about the focus or distraction from other things? I mean, in the Lilly numbers, the cancer drugs coming in below estimates, a delay on Alzheimer's treatments that they're working on, perhaps. I mean, where does that leave focus on other medicines?
Yeah, I mean, you know, the entire call... OK, that's not fair. There were 2 or 3 questions about Alzheimer's. Was about obesity and supply, right? And competitive products that are being developed by Novo and others. That was pretty much 90% or 95% of the call. So you are absolutely right. That is what's occupied. But that is the growth driver. And let's not forget, these drugs aren't just obesity drugs. They reduce your risk of heart disease. They reduce your risk of shortness of breath or having breathing issues during sleep apnea. And I think they're going to be doing more than that. And we've seen already a possible impact on colorectal cancer. So these are not just obesity drugs.
When Sam Fazeli sees me in the office, OK?
He runs a mile.
He basically walks in the other direction, OK?
Oh, is that the time?
Yes, exactly. I track him down. In order to find out kind of what's going on in terms of the latest kind of really interesting science. You joined us with some interesting stuff the other day, talking about what's happening in the cancer space. Rheumatoid arthritis. So talk to me about, because this is something that affects an awful lot of people. It's a disease that I think a lot of people are hoping that there's going to be some progress on. There's quite big signs now that can happen. Walk us through what the latest is.
Yeah, so Guy, it's actually related to what we were talking about that session.
Yep.
If anybody remembers. We talked about these engineered T cells that are being used for cancer, but folks are thinking about, can I use them in treating autoimmune disease? Because it's basically your immune system getting overactivated when you have autoimmune disease. So can I damp it down?
Yep.
So this paper we're talking about, you've seen evidence of that in lupus. You've seen perhaps some other indications that you might be seeing a possibility to reduce the immune system and treat the disease. We hadn't seen any data in rheumatoid arthritis, which is interesting because it's one of the biggest autoimmune diseases around.
Yep.
So there was a paper published in Nature which showed that you can use this currently available cancer drug again that attacks one of the immune cells called B cells. And with 2 doses, they got fantastic remission, only a few patients, right?
Yep.
Out to 3 months. 2 doses, 3 months.
Remission.
And these are people, yes, and radiographic too, with the imaging. These are people who have had everything thrown at them. There is not much left for them. So early days, very early days, but this modulating the immune system, which is what we've been doing all along with other ways of doing it, but this is a much more powerful way, it seems, to be able to get refractory disease under control. They do have side effects. Let's not forget about that. When you get rid of your immune system, you're exposed to infections. So that has to be balanced. But this is an evolving field which I think is going to be super interesting.
And who's making this stuff, Sam?
But this particular drug is an Amgen drug. I don't necessarily think this was their trial, but there are many people following this path, including Lilly.
OK, there you go. It's worth tracking Sam Fazeli down. Let me assure you of that, despite the fact he's quite a fast runner in the opposite direction. Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli. We're going to watch out for Nova tomorrow. Keep an eye on that. Today, quieter session in so many ways because London is probably one of the few markets that is open, but it's going to build up throughout the day. If you're off today, you're going to miss a lot of action because, of course, 1:30 p.m. we get the quarterly refunding out of the United States before an early indication at the beginning of the week on the size and scope. We get detail now on that. We get JOLTS data today. That's at 3 p.m. That's 10 a.m. Eastern. ISM manufacturing. Pay attention to that. It's Labour Day, so most people won't be paying attention to that. But finally, obviously, the main event comes through at 7 p.m. The Fed is going to announce their latest interest rate decision or lack of decision or guidance, I think is probably what we're really looking for. How hawkish will Powell really be?
That is the question, isn't it? I wanted to linger slightly on the Ozempic story because, yes, we've got Novo tomorrow and we've got a great... I mean, it is a fairly quiet day as we wait for the Fed, so you might have time to read one of our big take stories. Novo Nordisk is eating Denmark. I like the graphic that we attached to this.
I think it's feeding Denmark. So I kind of read the story and went, isn't that the wrong way around? It's not eating Denmark, it's feeding Denmark.
Well, it's certainly consuming Denmark in the sense that everyone's attached to this story, increasingly attached to this story in one way or another, and trying to avoid the Nokia effect, which is what we saw with Finland, where the economy became, you know, extremely addicted to one particular industry, and it gets into all areas of the country. And they talk about even philanthropy in Denmark in this story is being dominated by this space, you know, up against Maersk and Lego and Carlsberg and some other big names. This is the big corporate in terms of philanthropy.
I didn't know Lego was Danish.
Yes.
Yeah. Oh.
It is, Gritty.
Sorry, I think Legoland, and that's not in Denmark. But anyways, learning so much.
There is one there.
Is there?
Yeah. Anyway.
Can we take a field trip?
Never. I've been to Legoland once. It's never happening again.
I was hoping you mentioned this because South Korea, for example, has this issue as well, right? 33% of their index is just Samsung.
Yeah.
There you are,
And so that to your point.
But Danish GDP, like 6 million people, Danish GDP is higher because of this. Interest rates are lower because of this.
But the market cap of Novo is bigger than Danish GDP.
It's absolutely amazing. But as you say, what happens if this were to fall apart? And they are investing huge amounts of money in production there. Sam was talking about the fact that they have a capacity problem. There is a town that basically is manufacturing all this stuff, or will be manufacturing much more of this stuff for Denmark and the world.
OK, something to read whilst you're waiting for the Fed, because that's what's on the agenda a little bit later on today. We're waiting for the Fed, and we will, of course, bring you all of that coverage of the Fed. In the meantime, the European equity market looks like the FTSE up by 0.2%. Other markets largely closed. US futures pointing lower. Nasdaq futures down by 0.6%. That is it for markets today. It's a bit of a foggy morning this morning in London. The Pulse is up next. This is Bloomberg.